Welcome to Valkyrie Simple Finance. Understanding before investing. What is investing, and how does it really work? From stocks and ETFs to bonds and beyond, this series breaks it all down. Simply, clearly, step by step. Let's begin. What does investing actually mean? Is it buying stocks, trading crypto, watching charts, or is it something much simpler? For beginners, investing feels complicated, but at its core, investing is simple. Investing means putting your money into assets that have the potential to grow over time or generate income. Time is the most powerful force in investing. Not speed, not hype, time. Investing is not gambling, it's not chasing hot tips, and it's not getting rich overnight. All investing decisions are built on three foundations: risk, return, time. Imagine you invest $1,000 into a small business. If the business grows, your investment grows. If it generates profit, you may receive income. When you buy shares in a company, you're buying a small ownership stake. If the company succeeds, you benefit. When profits are reinvested, growth accelerates. This is called compounding, and it's one of the most powerful forces in finance. Beginners often lose money not because investing is broken, but because they misunderstand risk or ignore time. Successful investing is about structure, discipline, and patience. It's a process, not an event. In this series, we'll break down every major concept, step by step, so you can invest with clarity and confidence. What is the stock market, really? Is it a casino, a giant trading screen, or something much simpler? The stock market is not a casino. It is simply a marketplace. When you buy a stock, you are buying a small piece of a company. That piece is called a share. Companies sell shares to raise money, to grow, expand, invest, or reduce debt. Investors buy shares because they believe the company will grow, generate profits, or pay income. Stock prices move based on supply and demand. If more people want to buy than sell, prices rise. In the short term, prices move based on emotion, news, and speculation. In the long term, prices follow business performance. Stock exchanges are organized platforms where buyers and sellers meet electronically. Private companies are owned by a small group of investors. Public companies list their shares so anyone can buy them. The market feels risky because prices move every day, but volatility is not the same as permanent loss. The stock market is simply a tool, a system that allows businesses to raise capital and investors to participate in growth. So remember, the stock market is a marketplace. Stocks represent ownership. Prices move based on supply and demand, and long-term results follow business performance. In the next episode, we'll explain the main types of investments beginners should understand, including stocks, ETFs, and bonds. You've heard the terms stocks, ETFs, bonds, but what are they really, and which one should a beginner choose? These are not competing ideas. They are different types of investments, each with a different role. A stock represents ownership in a company. When you buy a stock, you own a small part of that business. Stocks can generate returns in two ways: price appreciation and dividends. Stocks can also fall in value. Individual companies can struggle or even fail. An ETF, or exchange-traded fund, is a basket of investments grouped together. If one company performs poorly, others may perform well. This is called diversification. ETFs can track entire markets, sectors, regions, or specific strategies. A bond is a loan. When you buy a bond, you are lending money to a government or a company. In return, you receive interest payments and your original money back at maturity. Bonds are generally less volatile than stocks, but they usually offer lower long-term returns. So let's simplify. For many beginners, broad market ETFs offer a balanced starting point. They provide diversification without requiring stock selection. Your choice depends on two things: how much risk you can tolerate and how long you can invest. Stocks represent ownership. ETFs provide diversification. Bonds represent lending. Each serves a purpose. Once you understand stocks, ETFs, and bonds, the next question is simple. How do you combine them into a portfolio? A portfolio is simply the collection of investments you own. A portfolio matters because diversification reduces risk. Instead of relying on a single investment, you spread risk across multiple assets. Building a portfolio involves three key decisions. Asset allocation means deciding how much of your portfolio goes into different asset types. Stocks offer higher long-term growth potential, but they can be volatile. Bonds tend to be more stable but usually grow more slowly. For many beginners, broad market ETFs provide diversification in a single investment. A simple beginner portfolio might look something like this. The longer your time horizon, the more risk you can typically tolerate. Risk tolerance is personal. Some investors stay calm during market volatility. Others feel stress when markets fall. Over time, portfolio weights change as investments grow at different speeds. Rebalancing restores your original allocation. Many beginners make the same mistakes. A simple portfolio is often the most effective. Clarity, diversification, and patience usually outperform complexity. A strong beginner portfolio focuses on three principles: diversification, asset allocation, long-term discipline. Most beginner investors don't lose money because investing is difficult. They lose money because they make the same predictable mistakes. The good news is that most investing mistakes are preventable, if you know what to watch for. The first mistake is chasing fast money. Investing works through patience and compounding, not shortcuts. Many beginners buy investments they don't understand. Putting all your money into a single investment creates unnecessary risk. Markets move up and down. Emotional investors panic during declines and buy during excitement. Trying to predict short-term market movements is extremely difficult, even for professionals. Small fees can quietly reduce long-term returns. Many beginners invest without a clear plan, but investing works best when it follows a structure. Successful investing doesn't require complex strategies. It requires discipline. The greatest advantage beginners have is time. Long-term investing allows compounding to work. Remember the 7 mistakes. Most people don't fail at investing because it's complicated. They fail because they never start. In this video, I'll show you exactly how to start investing step by step. No jargon, no confusion, Just a simple plan you can follow today. Let's break this down into 5 simple steps. Step 1. Get your foundations right. Before you invest, make sure you have an emergency fund, pay down high-interest debt, and understand your monthly cash flow, because investing without a foundation is just risk, not strategy. Step 2. Define your goal. Are you investing for retirement, income, or long-term wealth? Your goal determines your strategy. Step 3. Choose what to invest in. For most beginners, the simplest option is a broad market ETF. It gives you instant diversification without needing to pick individual stocks. Step 4. Open an investment account. This is where you buy and hold your investments. Look for low fees, easy-to-use platforms, and access to global markets. Step 5. Start small and stay consistent. You don't need a lot of money to begin. What matters is investing regularly, because consistency is what builds long-term results. The biggest mistake beginners make? Waiting for the perfect time. There is no perfect time. The best time to start was yesterday. The second best time is today. Investing doesn't need to be complicated. It just needs to be consistent. Most beginners start investing, then make one mistake. They buy one thing and hope it works. But real investors don't rely on one investment. They build portfolios. In this video, I'll show you how to build your first portfolio simple, diversified, and designed for long-term growth. A portfolio is simply a collection of investments. Instead of relying on one asset, you spread your money across many. Diversification reduces risk. If one investment performs badly, others can balance it out. Here's the key idea. You don't need dozens of investments. You just need the right structure. First, equities. This is where your growth comes from. A broad market ETF gives you exposure to hundreds or even thousands of companies. Second, bonds. Bonds provide stability. They don't grow as fast, but they help smooth out market volatility. Third, cash. Cash gives you flexibility and protection during uncertain times. A simple beginner portfolio might look like this: 60% equities, 30% bonds, and 10% cash. If you want more growth, you increase equities. If you want more stability, you increase bonds. Your portfolio should match your risk tolerance. The biggest mistake? Overcomplicating it. Too many investments. Too much trading. The best portfolios are simple, diversified, and held for the long term. Over time, your portfolio will drift. Rebalancing brings it back to your target mix. A great portfolio isn't about picking winners. It's about building a system that works over time. How much should you actually invest? $100? $1,000? Everything you have? Here's the truth. There is no single answer. Because the right amount depends on you. In this video, I'll show you exactly how to decide, based on 3 simple factors. First, your financial position. Before investing, you should have an emergency fund, control high-interest debt, and know your monthly expenses. Only invest money you can afford to leave invested. Second, your time horizon. How long can you leave your money invested? The longer your time horizon, the more risk you can take, because you have time to recover from market drops. Third, your risk tolerance. How comfortable are you with your investments going up and down? If you panic when markets fall, you're taking too much risk. So how much should you invest? Start with an amount you're comfortable with, then increase it over time. A simple rule for beginners: invest a fixed percentage of your income regularly. For example, if you invest 10% of your income every month, you build consistency, and that's what drives long-term results. The biggest mistake? Investing too much too soon and then pulling out when markets fall. A better approach? Start small, stay consistent, increase over time. Because investing isn't about how much you start with, it's about how consistently you invest. The right amount to invest is simple. It's what you can afford, what you can stick with, and what matches your goals. Most people think they're investing, but they're not. They're trading and losing money. And the difference between investing and trading is the difference between building wealth and destroying it. In this video, I'll show you the key differences and why most beginners get this completely wrong. Investing is simple. You buy assets and hold them for the long term. You're focused on growth over years, not days. Trading is very different. It's short term. You're trying to profit from price movements, often over days, hours, or even minutes. The first key difference is time. Investors think in years. Traders think in days. Investors rely on long-term growth. Traders rely on timing, and timing is extremely difficult. Trading carries much higher risk because short-term movements are unpredictable. Here's the reality. Most traders lose money, especially beginners, because trading requires experience, discipline, and emotional control, and most beginners don't have these yet. The biggest trap? Thinking you're investing when you're actually trading. For most people, the smarter approach is simple. Invest regularly. Hold for the long term. Ignore short-term noise. Because wealth isn't built by reacting. It's built by staying invested. Investing is about patience. Trading is about timing. And timing is where most people lose. The market will fall. And when it does, most people panic. But this is where real investors are made. Not when markets rise, but when they fall. In this video, I'll show you how to stay consistent, so you don't make the mistakes that cost most people their long-term returns. First, understand this. Market drops are normal. They happen regularly, and they're part of how markets work. The problem isn't the market. It's how people react to it. Fear leads to selling, and selling locks in losses. Most people sell when prices fall, and then buy back later when prices are higher. Real investors think differently. They understand that short-term drops don't change long-term growth. Rule number 1. Stay invested. Because missing just a few of the best days can dramatically reduce your returns. Rule number 2. Keep investing. When markets fall, your regular investments buy more. Rule number 3. Ignore the noise. Headlines, predictions, and panic don't build wealth, discipline does. Here's the key insight. Market drops feel like risk, but for long-term investors, they're opportunities. The real edge in investing isn't intelligence. It's behavior. If you can stay consistent when markets fall, you're already ahead of most investors. You now have everything you need to start investing, and do it properly. If you are enjoying this series, don't forget to like, comment, and subscribe for more.